studying your last two. I swim med tea when they turned in. The staring down to mute. And can lend a pole that some kid died.
When a corporation has a December 31st year-end, investment income reporting is usually very straightforward. On the left side of the slide, we can see what I call the easy world. The corporation's fiscal year runs from January 1st to December 31st, and the investment reporting documents, such as T3 slips, T5 slips, and brokerage tax reports, are also prepared for the exact same period. Everything lines up perfectly. As a result, bookkeeping is easier. Reconciliations are simpler. Tax returns can be prepared more efficiently, and the risk of reporting errors is reduced. However, things change dramatically when a corporation has a non-calendar fiscal year-end. Let's look at the example on the right side of the slide. Suppose a corporation has a fiscal year that runs from April 1st, 2024 to March 31st, 2025. The corporation must report its income based on that fiscal period. But the T5 slip it receives is prepared on a calendar year basis and covers January 1st, 2025 to December 31st, 2025. Immediately, we have a problem. Part of the income reported on that T5 belongs to one corporate taxation year, while another portion belongs to a completely different taxation year. The reporting periods no longer match. This timing mismatch is the root cause of most investment income reporting challenges for corporations with non-calendar year ends. At the bottom of the slide, notice the fundamental difference. Investment institutions report using calendar years, while corporations report using fiscal years. When those two reporting periods are different, accountants must perform additional analysis, allocate income between years, reconcile timing differences, and apply professional judgment to ensure income is reported correctly. This is the key concept to remember from this slide. T-slips follow calendar years, but corporations follow fiscal years. And when those periods don't align, investment income reporting becomes significantly more complex. Now that we understand why non-calendar year ends create reporting challenges, the next question is, do all investments create the same level of difficulty? The answer is no. Some investments are relatively easy to report, while others require estimates, judgment, and additional analysis. Let's start with the easiest category, GICs and term deposits. These investments typically generate interest income that is clearly shown on bank statements or investment statements throughout the year. Because the interest earned during the fiscal year can be identified directly, the accountant can simply total the interest that belongs to the corporation's taxation year and record it. In most cases, the statements themselves provide all the information needed. The second relatively easy category is Canadian dividend-paying stocks. Examples include bank shares, utility companies, telecommunications companies, and other publicly traded dividend-paying investments. Dividends are usually paid monthly or quarterly and are clearly visible on brokerage statements. The accountant can simply record the dividends that were actually received during the fiscal year. Again, the reporting process is usually straightforward. Now let's move to the category that creates the biggest challenge: mutual funds. At first glance, a mutual fund statement may appear simple. It might show that the corporation received a distribution of $1,000. However, the statement often does not tell us what that distribution contains. That $1,000 could include interest income, eligible dividends, capital gains, foreign income, return of capital, or a combination of several different components. The detailed tax breakdown is usually not available until the T3 slip is issued after the end of the calendar year. And that is where the problem begins. The corporation needs to prepare financial statements, calculate taxable income, and file its tax return before that detailed information is available. This is why mutual funds create the largest reporting challenges for corporations with non-calendar year ends. At the same time, it's important to understand what CRA is really looking for. CRA generally wants income to be reported, taxes to be calculated correctly, and a reasonable and consistent methodology to be applied. In many situations, perfect precision is not possible. What matters most is that the approach is reasonable, supportable, and consistently applied from year to year. Finally, notice the concept of materiality at the bottom of the slide. For a small investment portfolio generating only a few $1,000s of income, spending many hours creating highly detailed allocations may not be practical. However, for a corporation with a very large investment portfolio, even small classification errors can have significant tax consequences. As investment income grows, accuracy becomes increasingly important. The key takeaway from this slide is simple. GICs and dividend stocks are generally easy to report. Mutual funds are significantly more complex because their tax characteristics are often unknown until later. And regardless of the investment type, a tax preparer should always apply a reasonable, documented, and consistent methodology. Now that we understand the reporting challenges created by non-calendar year ends, let's look at how professional tax preparers approach the problem in practice. When investment income and T-slip reporting periods do not perfectly align, experienced accountants do not simply guess. Instead, they follow a structured process and apply professional judgment. The process begins by identifying the corporation's fiscal year-end. This is one of the most important pieces of information because the corporation must report income based on its taxation year, not necessarily the period covered by the T-slips. Next, the accountant reviews monthly investment statements and brokerage records. These statements often provide information that is available long before the final T3 or T5 slips arrive. The accountant then tracks the actual income received during the fiscal year, including interest, dividends, and investment distributions. Where possible, the various components of investment income are separated and classified appropriately. This may include interest income, dividend income, capital gains, foreign income, or return of capital. Once the official T-slips become available, they are used as supporting evidence and as part of the reconciliation process. Finally, the methodology and calculations are documented in working papers so that the approach can be understood, reviewed, and consistently applied in future years. Just as important as knowing what to do is understanding what mistakes to avoid. One common mistake is using an entire T5 slip for a corporation with a non-calendar year end without considering whether the reporting periods match. Another mistake is ignoring the corporation's fiscal year dates and focusing only on the information shown on the tax slips. Many new preparers also assume that all investments create the same reporting challenges. In reality, mutual funds are usually much more complex than GICs or dividend-paying stocks. Changing methodologies from year to year is another common problem. A method that is reasonable and consistently applied is usually far easier to defend than constantly switching approaches. Preparers should also consider materiality. The level of effort should be appropriate for the size of the investment portfolio and the significance of the tax consequences. And finally, investment income should never be viewed in isolation. For many corporations, passive investment income can affect access to the small business deduction, making accurate reporting even more important. At the center of all of this is professional judgment. A good accountant balances two competing objectives. On one side is accuracy. On the other side is practicality. The goal is not necessarily to achieve perfect precision in every situation. The goal is to report income correctly, calculate tax reasonably, and use a methodology that can be supported and explained. This leads us to the golden rule of investment income reporting. Report all income. Use a reasonable approach. Apply the methodology consistently from year to year, and document your work thoroughly. If you follow those principles, you will usually arrive at a reporting position that is accurate, defensible, and professionally sound. The most important takeaway from this lesson is that investment income reporting is not about achieving perfect precision. It is about applying a reasonable, consistent, and supportable methodology that ensures all income is ultimately reported correctly.